Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. Back on the program with us today is Lior Gantz. He's the founder and publisher of Wealth Research Group, which can be found at wealthresearchgroup.com. Lior, thanks for joining us back on the program today.
Thanks for having me, Colin.
Lior, your website is oriented towards providing market research, identifying trends, and stock selection. And much of your content, I find, leads back to the commodities space and alternative investments. So we're on the same page in terms of finding deep value. I think since we last talked, a lot of the things that you had identified, like equities being overvalued and central bank printing money, has continued, and yet the trend has not changed that much in our favor yet. What's your thoughts these days on where everything's going?
Well, right now, if you're looking at the 2011 to 2017 gold chart, you're seeing that it's facing its biggest trial yet. If you look at the wedge, at the trend line, it broke through the resistance about a month ago and snapped to 52-week highs. It's now going back and testing the new support line, which was the resistance. And so if the bulls and the buyers can hold fort and manage to keep these levels at the 1300s and the low 1280s, we're going to see no further resistance all the way up to 1400. It's a huge trial, and I think what's going to really affect it is what's going to happen with the next rate hike. If it is going to be in December, this will be one of the most important moments for gold in 2017 and going forward. So again, it's a huge trial. If it can sustain these levels and become strong, the sellers will go away, or more of the sellers will go away than there are buyers, and we'll see a much refined market. And I think, Colin, that is what is holding back speculative money or institutional money that we saw in early 2016 when there were no sellers, just buyers for about 8 months, or much less sellers. So right now, for me, this is a key moment. Now, with regards to what you're saying about the S&P 500 and money printing, let me address these two issues. One, for money printing, you got to realize that the central banks, including the U.S. and the Federal Reserve, do not print most of or do not issue or create most of the currency in the world. It is the private sector. It is corporations. It is people that are swiping their card, taking out a mortgage, originating car loans, etc., that create most of the currency in the world. And what you're seeing is that the U.S. is exporting a lot of the dollars that they're creating, and this has allowed the Federal Reserve to do its QE programs, to do its bond purchases, to do a lot of expansion to their monetary supply without creating excessive inflation. And that has that has a very frustrating aspect to gold investors, because it didn't create the sort of inflation that they thought this will lead to. So gold is a double-edged sword. So on one hand, when you buy physical metals, you want the price to be as low as possible because you're buying insurance. But on the flip side, if you're looking to make speculative gains, you want the price to go up, because that creates the spread for the miners, that creates speculative money for mergers, and brings a lot of price gains to explorers and developers, optionality plays, etc. So going forward, I think what you're going to see is the last caveat before gold really explodes is that the S&P 500, the Dow, and the NASDAQ, they must stop being so compelling to investors. If I'm an investor, if I'm an institutional pension or a pension fund right now, and there's the choice between zero interest rates with corporate bonds or with government bonds, or buying Apple, which pays me 2 or 3% dividends, That's why the stock market keeps going up, because these companies, they must show some sort of earnings to their to their clients, and they can't do it with bonds, so they just do it with stocks, and they're not geared towards buying exotic instruments, either the large indices or bonds. So they go into the large indices. Once this trend stops or reverses with another rate hike, which makes bonds more attractive, you're going to see this split. And we're really approaching 1999 scenarios here, where the stock market is booming and everyone is looking at low volatility. And we remember that once that trend reversed, gold stocks were used as a hedge. So, in my opinion, this is not the time to pile in. If you're not sophisticated, don't pile in, because there's no rush. What I've been doing for a year now is taking stink bids with the top quality companies that I like, and on the flip side, shorting the gold basket using one of the ETFs that's short to hedge my position. So that's how I've been able to dollar cost average on one aspect of this, and use sophisticated hedging tools to make sure that I make money when gold is correcting down. Again, this is something that you should do with a limited proportion of your portfolio. This is not the bulk of your portfolio. This is speculative. It's risky. It's hard. It's all of the above. It's worth the gains if you know what you're doing, obviously. And I'll leave it at that. Oh, by the way, Colin, we created a special report for your listeners regarding exactly these strategies at wealthresearchgroup.com/gold playbook. So if you're looking for the fullest, the most complete overview of all of this, you're more than welcome. It's a special report, and it's for free for your listeners.
Thanks for that. Lior, you mentioned the 1999 market crash, which did lead to an epic rally in gold and the gold stocks. More recently, though, gold stock investors are probably thinking of 2008, when a market crash brought down the gold stocks. Now, we put out a piece a couple weeks ago that you probably saw in Palisade Research, showing that in times when gold stocks were underperforming against the S&P and the S&P crashed, gold stocks actually do well. And times like 2008, when they're both performing well, they both crash. Have you done any looking into this?
I actually have, and it's funny that you bring this up, because I wrote about it extensively in the last 2 months at Wealth Research Group. And what I said was that 2008 was the exception, not the rule. Between 2001, if you plot a chart of the S&P 500 between 2001 and 2008, you'll see that investors have made no money. It was a sideways market. So when you have a credit crunch, which is far from what we have right now, institutions, corporations, even investors are very, very liquid right now. There's plenty of cash to go around. There's no liquidity crunch like in 2008. Going back to 2008, if you look at the broad market, you haven't made any money in 8 years. When a credit crunch came, you had to sell, right? You have to sell. You have to liquidate. Your broker is calling for margin calls. So what do? You sell what you have to, which is what you haven't made money on, right? You sell your S&P 500 stocks. You sell your Dow stock, your NASDAQ stocks. But then it's not enough. So you have to sell where you've made gains. And what was hot before the 2008 recession? It was gold stocks that went up for 7 straight years. So when investors had the chance to take profits because they were scared, they did. And right now, flip this around, because in the last 9 years, investors have made nothing but pure, thick, fat profits with all of the safest businesses in the world. And with gold stocks, they've been massacred. So, the people who are holding junior gold stocks right now are the people who will hold them even if they drop an extra 20%, because they're long-term, hardcore value investors with regards to gold and silver. So I don't see them selling into any panic, because they have no incentive to. They're already in the red, most of them. On the flip side, you see tons of institutional money that can take profits from the S&P 500, the Nasdaq, the Dow, which are at record highs, and then move them into the cheapest sector on the planet right now, which is commodities. And usually industrial metals and precious metals lead that commodity sector, not the agriculture stocks. So you might see an initial, like a 4 or 5 days reaction where everything goes down together, but then you'll see them splitting. Gold stocks will be a hedge going forward. It's not even a question. The probability of this is very, very high. There is no incentive for gold stocks to sell off, for silver stocks to sell off. What happened was, Colin, between August of 2016 and now, the last year, what you've seen is you've seen the junior mining sector basically diverge into two. You have the top quality companies that are run by people who haven't failed their shareholders ever, and the shareholders have remained bullish through thick and thin, supporting the company, supporting the stock prices. And you've seen the rest of the companies who have less proven management teams sell off big. So remember, the currency for junior mining stocks is the share price. If they can dilute less and raise money with higher share prices, they're far better off than the ones that have to fight to raise money. And so I think the junior mining sector is ready because some of the stocks are very healthy, and this will drive speculative money back. Right now, speculative money is looking at blockchain technology, and it's looking right now at Q4 and Q1 and 2 of 2018. It will look at cannabis. Cannabis will be one of the most important speculative opportunities of the coming 3 quarters, because California is legalizing fully on January 1st, and Canada is going to be the second country to fully legalize by July 1st. Canada and California put together are bigger than all of the other 29 states that are currently legalized. So I'm talking about a major opportunity, and I think all of this plays right into your audience's ability to take considerable and calculated risk, when they want to make large returns and not moderate or average returns.
Lior, you're correct that the gold stocks are bifurcating a bit, but there's also quality stocks with quality management that are not performing well. And it seems apparent to me that the gold stocks are underperforming relative to gold. I think you kind of just touched on why this is, but you'd think with gold, just having gone well above 1,300, now holding in at 1,290, that the gold stocks would be doing slightly better than they are.
Again, I don't think so, because the speculative money is not there. What really creates, astronomical price gains with junior mining stocks is when institutional money comes in to the large cap companies and forces them to raise dividends and make acquisitions. When they go to Barrick, when they go to to the large ones, and they tell them, look, we want you to raise dividends. You're making money. The margins are big. Start making acquisitions to replace your depleting assets. And then there's a bidding frenzy for the smaller cap companies, and the smart money goes there. And so you're not seeing that yet, and that therefore, even though it's quite surprising that gold is holding at 1,300 with the stock market's doing so well, it's not enough to attract the large smart money yet. I do say yet, because once these things happen, once these elements happen, gold rising again to the 52-week highs, the S&P 500 stops being so attractive, and you're going to see the speculative money return. And then you're going to see a period, which is usually 2 to 5 years, where the large gains do happen, Colin. And it's not going to be only with the quality ones. When there's a frenzy, many companies that are subpar also make a lot of money. So with regards to that, I think we have to look at the December rate hike and see how the market reacts to that. and then figure out our next move, our next large move as investors.
Lior, final question for you. It's well known in the gold space that silver is trading historically well outside of the historical mean, which is oftentimes referenced at 16 to 1 or thereabouts. We're currently at 75 to 1. But I've been hearing similar stories about this for many years, and it has been the case. Have you done any research as to what will flip this back, or if investors can expect this to happen in a year or a decade or 100 years?
Well, regarding the 16 to 1, that was a period when gold and silver, mostly silver, were actually used in modern day in trading. So you're talking about the Ottoman Empire, or that's the most recent one, about 200 years ago. And yeah, when silver was only treated as a precious metal, it had that premium that is attached to precious metals, because gold is not in short supply, right? All the gold that has ever been mined is above ground. It's not like there's a shortage of gold. It's just that what moves the price of gold is investment demand. How much people are willing to pay for pure money, for gold. And with silver, it's right now traded as an industrial commodity, so it's trading just above its cost. It's cost to produce. So it's trading for 17 or 18 because most companies produce at 13 or 14 or 15. But if you want to attach a premium to it, which will take it to, let's say, 30 or 40 or 50, some people say higher. If you want to have that aspect of it, it needs to start trading as a precious metal again. And for that to happen, all of the previously mentioned things need to happen. The stock market needs to be correcting, volatility needs to be higher, and then people flock into safe havens like silver. Institutional money is if you call the large bullion dealers or the large safe, the vaults, and you ask them whether or not the institutions, the large companies that are storing precious metals are buying gold or silver, they'll tell you that none of them are buying silver. It's just the retail people that are buying silver. So if you want silver to be treated as a precious metal again, that is what's going to cause it to go back to 50 or 40 or 30 to 1, who knows, right? When silver outperforms gold, I can tell you that the mining shares outperform both of them. So at 75 to 1, there's a higher likelihood that silver will outperform gold in the near future, and then that stocks will perform the physical metal as well. And by the way, I created a blueprint, like a master plan of how to prepare, anticipate, and thrive through the coming crash. And it's personally what I'm doing. So you can go to wealthresearchgroup.com/crash and download a special report about exactly how we're preparing ourselves. And we have like a broad master plan on how to deal with what's going to happen according to just what we discussed now, Colin.
Excellent. Lior, I really appreciate you coming back on the program today once again.
No problem.
For our listeners, wealthresearchgroup.com, and Lior is the founder and publisher there. Lior, thanks again.
Hey, thanks for having me.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?